on the city's payroll apportionment rules that we'll talk about. What are gross receipts? San Francisco has a pretty broad definition of what is gross receipts. They don't allow too many exclusions, but generally it's the amounts derived from sales, services, dealings in property, interest, rent, royalties, dividends. Really it's the starting point is all amounts that constitute gross income for federal tax reporting purposes. So that's your starting point. There are certain exclusions that some companies may not be aware of. There isn't a deduction for cost of goods sold, but there is an exclusion for investment receipts. For instance, interest, dividends, cap gains, as long as it's received on the account of a financial instrument and isn't received from the provision of services. San Francisco has also said that they won't include PPP funds within the definition of gross receipts. So again, it's something to keep in mind if your company had included investment receipts that may have been excludable. You can always reach out to me and we can look into whether it's reasonable to amend that return. That could also include GILTI inclusions and other inclusions that you may have included on your apportionable gross receipts. You could look to determine whether this investment exclusion applies. And like I said, no more payroll expense tax starting in tax year 2021. But there's still the activity of having to calculate your San Francisco payroll factor to help apportion gross receipts to the city. And within that factor, the definition of payroll includes salaries, wages, bonuses, commissions, compensation for services to owners of pass-through entities, and any other form of compensation for services. So the next slides before we wrap up the presentation are going to go over about 12 tax strategies that you may or may not be aware of. The first one being the apportionment of payroll to San Francisco if you're one of those filers that use the payroll factor to apportion gross receipts, which a lot of companies use because they either use the apportionment method or the combination method. But in this age of a remote workforce, and historically, companies that were based in San Francisco may have just looked on their payroll report to determine which employees are based out of their San Francisco headquarter location. And sometimes these companies will take their total payroll for the year and attribute all that to San Francisco. Now that could be overstating your San Francisco payroll factor and in turn overstating your gross receipts tax liability by not accounting for San Francisco's payroll apportionment rules. And these rules generally say that payroll expense is attributable to the city looking at that amount of payroll which relates to the total number of working hours employed within the city. So really, if you're looking at how the language is applied, taxpayers should be looking at the amount of payroll which relates to working hours performed in the city. So again, if you have a remote employee who lives in the city during the pandemic, then most likely his compensation will be San Francisco source because he's performing or she's performing those working hours inside San Francisco. But let's say you had employees that were headquartered in San Francisco, but then during the pandemic and even currently work remotely and their home is located outside of San Francisco. Well, there's a strong position there that those working hours aren't performed inside the city, but are performed outside the city. So when you're looking at your payroll factor to apportion gross receipts to the city, that should be taken into consideration. And I can't tell you how many times I've seen companies overstate their San Francisco payroll factor. It's one of those things where, we should discuss how it was calculated historically to determine whether there's a refund opportunity, at least on last year's return, if this wasn't taken into consideration. Within that topic of apportioning payroll to the city, if you have employees whose payroll is determined based on the volume of business that they transact. So, salespersons who receive most of their compensation as commission, then San Francisco would look at the amount of volume of business that was transacted inside the city. So again, it's looking at really the working hours performed in the city, but if you're being compensated based on volume of work performed, then it's looking at how much of that volume of work was done inside San Francisco. All right, so the second strategy involves those certain taxpayers who may have received gross receipts from a related entity and perhaps reported that as taxable gross receipts on their San Francisco return. If San Francisco excludes as gross receipts amounts received from a related entity, but their definition of related entity is very specific to those companies that are permitted or required to have their income reported on the California combined income tax return. So if it's coming from an entity and you file a California combined report with that entity, then likely that would be considered a related entity for this exclusion. But if you're a pass-through entity, most likely you're not allowed to file those entities on the same California combined report. This related entity definition and exclusion wouldn't apply to you. So this strategy might be more applicable to a C Corp who received gross receipts from a related entity and may have reported that on their tax return. The third strategy involves a company who may be engaged in multiple business activities, who historically may have reported their gross receipts under one classification that has a high gross receipts tax rate bracket, but perhaps you're also engaged in other activities and receiving gross receipts from multiple revenue streams. So if some of those revenue streams are related to activities that have a lower gross receipts tax rate, then there are specific rules that allow you to separate those activities on your return instead of lumping all those gross receipts into a high tax rate classification. The next strategy, the benefit of this strategy was stronger for the 2020 tax year and before, based on San Francisco's recent changes in the gross receipts tax rates. But if you were a company who had historically reported gross receipts under the Professional, Scientific, and Technical Services classification, or PST, you had historically had a much higher tax rate than those in the information category. And so this strategy usually applies to software as a service companies who thought of themselves as a professional service company and classified themselves under the PST category. But if you were to look at the NAICS definition of information filers, it does include those who are engaged in software development, and information filers have had a much lower gross receipts tax rate bracket than the PST filers up until the 2021 year. So if this applied to you, if you were a SaaS company who may have reported gross receipts under the professional service and technical services category, you might want to determine whether information is more relevant, as there could be a large refund opportunity if the information category is more applicable to your company. The next strategy just talks about how San Francisco acknowledges those companies who file a California Water's Edge election. So generally, San Francisco takes a worldwide approach and requires companies to apportion their worldwide gross receipts and payroll to the city. But if you file under a Water's Edge election, then San Francisco usually will only look at those gross receipts and payroll from those members in the Water's Edge group. So this may not have been taken into consideration, and you may have included more gross receipts from your worldwide operations than you were required to do. The next strategy talks about a tax credit that that some companies have tried to take advantage of. It's called the substantially similar tax credit. So San Francisco, and it's section 954G in the municipal code, allows taxpayers to take a credit on those gross receipts that were sourced to San Francisco if those gross receipts, or if the taxpayer had paid a similar tax on those gross receipts to another jurisdiction. So, whether this taxing jurisdiction means just another city's tax, or if it means city and state, there's still some uncertainty as to what taxing jurisdiction includes for this credit. From my recent communication with some law firms in the city, Square is currently challenging that this credit should also include those taxes paid on these gross receipts at both the city and state level. So for instance, if you paid a Washington B&O tax, the Ohio commercial activities tax on gross receipts that were also apportioned to San Francisco, then, companies are challenging that this credit should also apply to these local level taxes as well, or these state level taxes as well. But it's still in the appeals process, to my understanding. But it's something to look at, and at least to file a protective refund claim for, because this credit was eliminated starting in the 2021 tax year. So key point here is if you paid a substantial amount of gross receipts type taxes to other jurisdictions, Washington B&O, Ohio, other jurisdictions that impose a gross receipts tax, then you may want to look at whether this credit applies and to file a amended return and refund claim. So the next strategy just talks about utilizing San Francisco's market-based sourcing rules. So if you're a taxpayer that uses one of the sourcing methods that either uses the allocation method or the combination method, it's important to go through how different types of gross receipts are sourced under this method. So obviously, if you earn gross receipts from intangible property, those that use the allocation method would source only those gross receipts from the property that is used in the city. So a lot of taxpayers who may be licensed and intangible will look at what sales were from billing addresses in San Francisco. But realistically, that IP may be used by other individuals who aren't based in the city. So the billing address in that instance may not be reflective of the actual receipts that were from property used in San Francisco. So it's important to understand that you don't want to overstate your San Francisco gross receipts because you should be looking at these specific rules and the types of gross receipts that you earn to make sure that you're sourcing them properly to the city. There's only 3 more strategies. I'm going to try to keep this within a half an hour or so. This next strategy just shows the importance of apportioning gross receipts properly, and how if gross receipts are over the small business exemption threshold by $1, then all of your gross receipts are taxed, as opposed to falling under the exemption threshold, then none of your San Francisco gross receipts are taxed. So this is an example of a venture capital management company who may have overstated their San Francisco payroll factor and reported $1,200,001 of San Francisco gross receipts. In this example, based on the 2020 tax rates, they would have paid close to $5,000 in gross receipts tax, where if they had properly calculated their San Francisco payroll factor by looking at, the working hours and where those working hours were actually performed, if they were to fall under that threshold, then none of those receipts would have been taxed. So again, this threshold, 1.2 million, increases to 2 million next year, but the same concept applies, where it's important to really hone in on your apportionment percentage, because going over this threshold by even $1 means that you pay tax on all those gross receipts